Today, we are going to talk about everyone's favorite subject, taxes.
Yay.
One of the things that I've noticed in the 15 plus years that I've been an advisor is that frequently the advice that someone gets from their CPA and the advice that our team is giving seem to be at odds with one another. And I think it's important to understand why that happens. And for starters, I think one of the reasons that happens is because of how our clients measure us, right? If you are looking at how you measure your CPA, you are looking at how much money your CPA saves you this year in taxes paid. And just for context, when we are looking at the tax implications of some of our recommendations, we are looking at taxes paid over a lifetime. So it's a very different scorecard, I think, that we are using to measure success.
Right. Well, or maybe more precisely, the taxes that you're going to pay later is also a measurement that we're looking at.
Right, right. So I think it would be really helpful to start maybe with a tax history. And so for those of you who are able to watch this, I will be sharing my screen so that you can see a little bit of tax history here. But we'll talk about it so that even if you aren't watching this podcast, you still have an idea of what's going on. So we're gonna start by talking about what has happened with taxes historically. So if you go back all the way to 1913, that is when taxes came into fruition in the United States, and the original tax rate was about 7%. And only for people who made over $500,000 in 1913, which was a very small segment of the population. And if I remember correctly, I believe it was also done on the honor system.
Right. Please send us your money, please.
So when we start looking through some of the historics, everything kind of stayed at that 7% level for the first several years. And then you see a pretty major jump in 1917, where the tax rate spiked to 67%. But again, that was only for people who were making over $2 million in 1917. So still a very small segment of the population.
Right. Well, and the cool thing about this chart is this is the top bracket. So this doesn't include other brackets or, lower payouts. It's just the top bracket.
Right. And so if you think about why that would have happened back then, it's because that's right around the time World War I was starting. So you see the taxes peak out during World War I, and then they start dropping back off pretty radically over the period of the next 5 to 10 years. And it drops back down to a level of 25% for anyone who's making over 100,000 in 1925. So even though the tax rate,
that it went down, but the amount of income you had to get or had to earn in order to be at that bracket dropped dramatically.
Right. So we call that widening the base, right? That means that instead of just a few people paying taxes, we are widening the percentage of the population, not we, I'm being very clear, it's not us doing it, but the percentage of the population that is paying taxes is widening. There are more people paying taxes at that point, even though it is at a lower bracket. And so you see that kind of continue on. And then you hit a time period where all of a sudden we're going to start to see a jump. So if you look at 1932, it jumps all of a sudden to 63%. So the highest tax bracket the year before was 25% for anyone paying over 100,000. But the very next year, they create much larger brackets for people who are substantially out earning. So the highest rate jumps suddenly to 63% for anyone who is earning over $1 million in 1932, which again is a pretty small percentage of the population. But you can see how just, from year to year, there's a pretty abrupt change that people may or may not have been expecting.
Right. And a lot of that, I think, is sort of Great Depression responsiveness, right? We got to go get more revenue, more services.
Right. So if you kind of keep tracking through that, everything kind of stays the same. And then over the next couple of years, in 1936, now it's a 79% tax bracket for anyone making over $5 million. And that kind of stays the same for a little bit. But in 1940, it jumps to 81%. So it's not a huge jump, but it's a little wiggle right there, again, for anyone making over 5 million. And then if you look at what happens with the advent of World War II, all of a sudden the tax rate is 88% for anyone making over 200,000. So again, while that may not be a huge portion of the population, if the year before you think you're sitting pretty because only people making 5 million are paying 81% in taxes, right, the very following year for anyone who's making 200 grand, they're paying 88% of anything they earn over that dollar amount to the government in the form of taxes. Right. And that number kind of continues to spike and grow during the war.
Yeah. And the interesting part of that is, you know, if you look at 1941 versus 42, it goes from a $5 million is what you've got to earn in order to be in that top bracket to 200K. And the interesting part, and this is why this is sort of, I think, our running commentary with, hey, let's pay taxes now and see if we can save them for later, is nobody in that bracket got a vote. That they went from 5 million to 200K, and there's nobody in that 200K range that said, you know, I think we should send more money to the war effort. Please take 83% or 82% of all my money, right?
And you start to, right, there's not a lot of control there. And I think that's part of what we want to talk about through this podcast, is that even as the war is wrapping up, you can see that the tax rate starts to kind of dribble back down. But for anyone earning over 400,000, the number is still pretty high at its kind of trough here. In 1949, it's 82% for anything over 400,000.
Right.
And that kind of holds steady for a while. So if you keep projecting it out through the 50s, for anybody earning over 400,000, they were paying upwards of 90% in taxes for a solid decade. More than a decade, actually. And I think that's really interesting because, you know, if you can imagine today being in a situation where you're earning income and you're sending 91% of every dollar you earn to the US, you get to keep 9 pennies and they get 91. I mean, I don't know about you, Eric, but if that's me, I'm hitting that point in the year going, yeah, this doesn't really seem worth it. I'm just going to go hang out in Mexico and I'll come back January 1 and start over. I'll just take a vacay.
Right. Well, you're radically changing how you do your business. You're thinking very differently about growth, about expansion, about, man, I wish I could go grow this so I could go hire more people, but it doesn't make any sense for me to do that. Right.
No, it really doesn't, because what is that revenue actually doing for you? Not much. It's doing something for someone. It's just not you. So if we kind of hop on down by 1964, Kennedy, right? You start to see some dips in here. So 1964, it drops a little bit. And then in 1965, it drops down from 91% to 70% for anyone who's earning over 200,000. And then that continues for, like another decade,
Reagan.
Decade and a half.
From Kennedy to Reagan, it stayed at that 70% mark pretty much.
And what I think is interesting is during the time period where the tax rate was over 90%, Ronald Reagan was acting, and he made a movie called Bedtime for Bonzo. I think, is that the name of the movie? Am I getting that right?
Yeah.
Which I don't think is particularly culturally significant, except that it was the highest grossing, or that as an actor, Ronald Reagan was the highest grossing actor for a single film. And it was, I think, the first time that someone was ever paid over $1 million for a single movie. And because he had earned a little bit ahead of that, it wasn't his only paycheck for the year. By the time he received that check, he was in that 90% plus bracket and ended up with a very small amount staying in his pocket, like just over 100,000, if I remember correctly. And you can see that influencing his politics later down the road. And regardless of how you feel about them, you can see cause and effect, right? You can see, I just earned a bunch of money and had to give all of it away, not voluntarily either. And then you see what happens when he gets into office. All of a sudden, we see a huge difference in the tax rate. And so you can see by 1982, the tax rate is dropping to 50%. That's before he's in office, but you can see it dropping to 50%. And that becomes 50% for anyone earning over 85,000. And then you see in 88, the tax rate drops to 28%.
Yeah.
But now that 28% is for anyone over 29,000 of income. So you see, again, now all of a sudden the tax rates are substantially lower. And I was having a conversation with somebody about this just a couple of weeks ago, and they were talking about the fact that Reagan's tax bill was revenue neutral. And the reason that it was able to be revenue neutral, even though you see a huge decrease in the overall tax rate, is that they broadened the base. So more people began paying taxes, but at a much, much lower rate across the board.
Yeah.
And then that's really kind of continued. We've had some ups and downs where we saw the tax rate in the 90s increase back up to 39.6. We saw that drop just a little bit to 35%. Then it went back up to 39.6. Then it dropped down to 37. And now there's discussion of taking it right back up to 39.6. Right. And so there's a lot of movement here. And I think that for me, I think the first time that I saw this particular tax chart or something like it was probably in the early 2000s. And I remember talking about it with my husband and talking about the importance of focusing on taxes. And I remember him saying initially, this is a scare tactic. You have to factor in inflation and all these other things. And I was like, but what am I trying to scare people into? Or what is this chart trying to scare? I mean, let's just look at what's actually happening so that we can make some decisions about where to go from here. And I'm sure if he was on the podcast with us, he would defend that statement, because I don't remember why he brought it up. I just remember him talking about scare tactics. But I think this is key, because a lot of times when we're talking to our clients, we ask them, were you aware that the tax rate has ever been above 90%? And frequently the answer is no. And I will go so far as to say, sometimes I ask CPAs what the highest marginal bracket has ever been, and they can't answer that question. And, we talk about this a lot, but I think when you have context, when you know what the facts are, you will know what to do. But if you don't have the facts, you might make very, very different decisions.
Right. Well, and that's that idea of where is it versus where was it? Mm-hmm. And if I had to make some guesses, some educated guesses, what would it be in the future? Mm-hmm. And I think that's a lot of that conversation today. And it goes back to that idea of the debt, which we'll get to in a second. But but if you look at the average is almost 60%, 57.3. Right.
In our history, the average of the highest marginal bracket is 57%. And you look at where we are today, and it's below 40. Right. So if I were looking at a concept, we talk about this sometimes in our office. This may be getting too technical for a podcast. I don't know, for this podcast. But we talk about the idea of regression to the mean, which means that if you take data over a long period of time, you can kind of figure out what the average looks like. And you're going to have years which are low or high, kind of outlying situations. But over time, the regression is always towards the middle. And so if we know the middle is 57%, and we are sitting in a situation where we are at 39%, we're almost, 20 points? Not quite, but we're almost 20 points below what the average has been. And knowing that the upside, I think the highest marginal bracket was 94%. Right. So knowing that's the upside, I would make different decisions in different environments. So if we were in a situation where the highest marginal bracket was above 60% and you were in that, I might say defer the taxes in the hope that we'll drop back below the line. But I have a hard time with the idea that deferring taxes is a good idea right now. Now, if I can offset the taxes, or I can create true tax deductions or tax credits, I think that becomes very interesting. But a deferral of taxes is a very different thing. And so I think it's important to make sure that we use the right language, because frequently I hear CPAs say, I saved my client X number of dollars in taxes this year. And when I ask them how they did it, it's putting money into an IRA or a SEP IRA or,
Right.
something
401.
that's deductible. And I think it's important to say you didn't save any money in taxes. You just deferred when you were going to pay them in those situations.
Yeah. Well, and that's the other component of that I always found sort of interesting on that conversation is if I look at where I am today, so I'm mid 40s, as my wife reminded me yesterday, and squarely in the mid 40s. And I've got 2 kids, a 9 and a 5-year-old. I've got a house. I'm working, I've got expenses that I get to write off each and every year for technology and all the things that we use to run the business. And so if I think about, do I want to pay the tax now or do I want to pay it later? I want to pay it right now. So if I think about a 401k deduction, and here's why. I'm going to go write a $10,000 tax bill this year. I'm making up a number. Well, if that was my gross tax bill, I have child tax credits I get to write off, got mortgage interest I might be able to write off. I've got business expenses, all of these things that can make that 10K lower. But if I fast forward that bill, if I put it into the 401k, save some of the taxes today, but defer it and pay it later, I'm 65 now, I'm 70 now. The kids are all out of the house. My gosh, I hope so. The house is paid off, so I don't have any interest I can write off. I'm not running a business anymore. I've retired. I'm doing other things. So as a percentage of my income, I'm going to pay a lot higher version of that number because I have no write-offs. I've got no natural write-offs on that number, unless I'm doing things like charity. But I've got no sort of baseline write-offs that I get to go push against that. So even if the tax brackets are the same, even if we're at 37% today and it's going to be 37 all the way through, I got all the write-offs right now. Why defer it later when I have no write-offs?
And I think it's important too to understand if you are deferring when you pay the taxes, when you have taxable income and you are retired, that affects your Medicare premiums. It increases them. And it also affects whether or not your Social Security comes to you tax-free or is taxable. So, it's important to think through the long-term implications of deferring all the taxes to a later date beyond just the tax rate, right? I mean, there's the write-offs, the expenses, all the things you just talked about, but there's also some of the material concerns of making your Social Security taxable and increasing your Medicare premiums. And they can get quite expensive. So, I think all of those things really matter as we're thinking through these conversations. And, some of the things that people look at doing may or may not be around in the next couple of years. So as of today's date, which is October 25th, 2021, you still have the ability to do what's called a backdoor Roth, where you can convert your IRA dollars from a traditional IRA into a Roth IRA. And when you do that, you have to pay the taxes. But if you do it correctly, there are no penalties during that conversion. And then you have all of those dollars set aside that can grow tax-free for the rest of your lifetime. But based on most of the talk and the bill that's currently being discussed, there's a pretty high likelihood that come 2022, that ability to do that will look very different if it exists at all. So there's a short window potentially where that could be very beneficial if changing from a tax deferral to tax-free growth is something that's interesting, which I think it is.
Yeah, and I think context is important too, right? If you really understand what's going on, we used to work with some federal employees, and I remember talking with one of them, and they were right on the cusp. The federal system was changing between an old pension system to the new pension system, and they were caught in the middle of that transition. And so they got a choice. They said, hey, look, you can be on the old system, the one you're on now, or you can move forward. And I remember talking with the gentleman, and he said, man, I spent hours and hours and hours trying to figure out which was the better pension, what was going to give him the best payout in the end. And then he finally got 4 hours, 10 hours into doing his math. He stopped and he says, wait a minute, this is stupid. Why would they change the system if it wasn't in their best interest? Nope, I'm going to stay on the old system. And so I think about 401ks and I look at things like RMDs, required minimum distributions. As you get older, the government wants their money. They want their money today and they want their money tomorrow. But if the government is smart and they're a going concern, right? They're smart cookies. They want their money at interest, just like you want your money at interest. So if I can defer my taxes and put money into 401k now, I'm I'm paying on the seed, right? And then that harvest gets bigger and bigger and bigger. The 401k gets bigger and bigger. And then when it comes out, I'm being taxed on the harvest.
Right.
Like I'm being taxed on the massive end on the other end of it. So the government is giving you a break today, but there's something in it for them or they wouldn't do it.
Right. Well, and I think too, context, I mean, context is always important. And if you are close to retirement and
Right.
you don't have enough funds saved up to replace 100% of your lifestyle, there's probably a pretty good chance that you will be in a lower tax bracket.
Absolutely.
And so a
That's a good
deferral
point.
could make sense in that situation. But if you are young and you have aggressive growth plans and you are building with the specific purpose of at the very least replacing your lifestyle, if not growing more, then a deferral may or may not make sense at that point, right? And I think that's where it's really important to talk to your own advisor about
Right.
your situation and to have the conversations about which bracket you fall into, where the risk is over time, and then make your investment decisions accordingly. Right. I mean, that I think is the key here. But I do think it is very, very important to go back to the idea of when someone says, oh, you're going to save X in taxes, you need to be asking the question, am I really saving it or am I just deferring it?
Well, and look at from whom you're getting the advice. What are they being measured on? Are they
Right.
being measured on how much they're saving you today versus how much you're going to have later on? And that you may get two different answers. And then the other part for context, and we talked about this, if you ever want to sort of get depressed on a Monday morning, there's a little website called the usdebtclock.org. And I think you had a different one pulled up, but if you just want to look at that's the one I was looking at. So the national debt right now, as a top left hand, if you're looking at it on the screen here, is what, $28.9 trillion, sort of the running national debt on this side of it. And I looked up the sort of year by year deficits, which I find equally depressing. 2001 was the last time we had an actual surplus, meaning we brought more money into the government in taxes and revenue than we paid out. And ever since then, it's been sort of an annual deficit. Every year we're adding to it. And so the funny part of it is if I remember the math, I'm going to pull it up here because I don't want to lie to you. That was the last time we had a surplus. 2001, we had a little bit of a deficit because we were fighting through that recession. 2008, 2009, as we're trying to pump money into the market, the deficit that year ran about 1.4 trillion. So we're racking up extra bills, right? We're spending money on the credit card. And the really, really sobering part of that is if you look at what happened last year, the deficit for 2020, we had COVID and everything else, was about 3 trillion, 3.2 trillion.
Mm-hmm.
So it is no small number, right? And so if I'm reading the tea leaves, it was 3.13 trillion last year. And so far this year, we're running a deficit of about 2.7 trillion. So I don't know what the future is going to look like.
But as debt gets bigger, the government's cash flow requirement gets higher.
Right? So just
well, and what's
for a little
happening now
context.
is when we see some of these tax proposals, the proposals for increased tax rates, we're not shrinking the base. So these are not revenue neutral tax proposals, right? I mean, this is about
Right.
creating extra revenue, right? And I want to stay away from the politics of all of this
Well,
because,
absolutely.
you know, it regardless of how you feel about it, I think addressing the facts of what's happening is what allows you to navigate the situation, right? And so
Right.
the whole point of today's conversation is really just to make sure you have the context of tax history and an idea of where potentially we could be headed so that you can make better decisions about your money. Because the whole point of working as hard as we all do for our money is so that we can actually build a life and a lifestyle for our families and to make an impact on the community around us. And the way you can do that is by being able to direct where you are spending your capital. You want to add anything to that? And then
and I'll close out with this. One of the funniest or one of the common refrains I hear is, well, I'm going to be earning less in retirement than I am now. And my response is, you've got a crappy advisor. So,
I 100% agree. Yeah, if
so
I,
you should be earning
every
more.
time somebody says that to me, I feel like I must have this blank stare, and then I just want to say, "You're doing it wrong."
Right? Or just to pause and go, but is that okay? Right?
Why are you settling for that? Absolutely. Well, this has been fun. Eric, I appreciate the conversation, and thank you guys for listening. You can
As
find
always.
me at The Wealth Woman, either on Facebook or Instagram, and you can find me as Mary Kane Lyons on LinkedIn.
Yeah. And I'm on Facebook and Instagram and all the rest of the grams as well. So on Facebook and Instagram, it's Economics with Eric. And then on LinkedIn, it's just my name. So
Eric, you
thank you
can
guys.
tell we're recording this on a Monday morning.
We're all tired. See you guys.
Have a great one.